Good afternoon, everyone. Thanks for having us back. As you can see on the screen today, we'll be discussing what history shows happens around presidential elections to both the economy as well as markets. And we all know that those two things are entirely different. It's been a very perplexing market this year for many investors, with unemployment at 8% currently, down from a high of 14.7%, an all-time high in April this year. 12% of workers are back in the office. Right? COVID cases are at record highs in 10 states and on the rise in 44 states. So, of course, what's happened to the market? Shockingly to many investors, it's up 49% from its March lows. It's made a tremendous move. In addition to that, what we will be discussing are Morgan Stanley's insights into this election, as well as outcomes we think can occur post-election. And who's counting, right? The election's only in 14 days, 9 hours, 58 minutes, and 39 seconds. I know our coworker here, Monica, has the same clock up. She's a little more involved than Becky and I for reasons you'll find out very shortly. So Becky and I are pleased to have Monica Guerra with us today. She's an investment strategist at Morgan Stanley and one of the authors of U.S. Policy Pulse, right? A history of general election performance, so we can make this available to everybody. So her work keeps financial advisors like us up to date with what's going on in Washington, D.C. And on top of that, her team identifies investment themes and opportunities that we share with our clients that our clients can benefit from. So I've got to hand it to the press. This has been a very stressful time for all of us, and they've managed to make it even more stressful. There's a couple of magazine covers that I thought you'd like to see. The first is from Time magazine in August of this year. The plague election. We can see our president trying to keep his head above water, the White House being flooded, and both being surrounded by the COVID virus. And one of my favorite magazines managed to come up with something that's very subtle: America's Ugly Election. How bad could it get? And that was from September of this year, and it seems like it may have gotten worse. So my bet is that the American Psychological Association may very well make living through a U.S. presidential election one of the most 10 stressful life events that people go through, probably somewhere between divorce and doing jail time. It's been an incredible time, both for investors as well as the general public, with everything that's going on in the economy. So with that, just a brief synopsis of the impact of presidential elections. Over the long term, market performance is more closely correlated with the business cycle, okay? More so than the political party in control. And conventional wisdom, frankly, frequently does not align with actual results. So with that, why don't we turn it over to my partner, Becky, along with Monica Guerra.
Thank you, Joe. It's wonderful to be with all of you again today. Again, this is Becky Brooks speaking, and we are very pleased to be with the Consortium of Endowed Episcopal Parishes, fondly known as SEEP, yet again. And we are equally as pleased to be presenting on a very timely topic that our firm has done a lot of historical research and analysis on. So yes, Joe, that was a great intro. We are talking about the U.S. presidential election. And yes, we are talking about potential economic and market outcomes as a result. These are difficult topics to wade through, and we have been getting calls from clients of every size and scope, a lot of institutional clients as well, in the preceding months, weeks, and days about these topics. And they're often with their perceived biases and about the outcomes in tow. Well, we are just delighted to have Monica Guerra here with us today to kind of sift through some of these topics, but with a historical, with a firm understanding on historical outcomes and how that can lead to maybe a slightly more rational, a different approach to how to deal with these issues. So I'll just give you the 2-second intro to Monica. Monica is a vice president and U.S. policy market strategist at Morgan Stanley Wealth Management, where she develops strategic market guidance, for financial advisors and clients. Besides her work at Morgan Stanley and as a municipal bond analyst, Monica has also served as Director of Capital Budget and Economic Development for the City of New York and as a legislative aide to the U.S. House of Representatives. So Monica, welcome to everyone. I'll just give you 2 seconds to introduce yourself before we get started with our conversation.
Yeah, thank you so much, Joe and Becky. I really appreciate the invitation. I wanted to just say that, this is a real treat for me. As my husband and I, well, we were both raised Catholic. We do attend St. John the Divine in New York City, and we actually got engaged at the National Cathedral in Washington, D.C., in the top bell tower. So there is a really strong connection for us in our life with the Episcopal faith. So, I want to thank you for giving me the opportunity to speak with everyone here today. Now, essentially what I really want to go through in this conversation with Becky is just to really hit home on the fact that, while we do expect changes, everything in reality tends to be a lot more tempered and moderate when we're thinking about actual application of public policy and how that impacts markets. So we'll do hopefully cover that and give you a nice overview and leave you here with some answers for you to take with you as we head towards November 3rd.
Terrific, thank you. So we'll just get right into it. And I think it's important to kind of lead off with where we are in the world today. Can you give us your thoughts on what has shaped the political landscape going into this election?
Yeah, absolutely. So, first, if you want to pull up our first slide, Becky, this is, when we think about fiscal stimulus, this has really been truly unprecedented, and that's a term we've been hearing a lot. But I wanted to show you this chart because it really hits home sort of the magnitude of what we're talking about here. So when you think about fiscal stimulus measures, including the CARES Act and Fed monetary policy, we're looking at an injection of liquidity equal to, now at this point, well over 50% of GDP. That's because there's been additional programs that they roll out and discuss, almost monthly at this point. And to put that in context, when you're dealing with, looking at the New Deal and the Great Depression, which gave us all the levers, right, that we're pulling today, that equaled just 5.7% of GDP. So the amount of money, right, in the system is staggering. Now, this is, really important because if you go to the next slide, you can see that after, right, the correction in March, which was incredibly steep and swift, positive market sentiment has picked up and continued actually through today. It's been a little choppy in recent weeks, but that's because it's all been hinged on this fiscal stimulus and the anticipation of more fiscal stimulus. So even today, if I'm on Bloomberg Terminal, you'll see a headline that says, markets are responding to the negotiations with Pelosi and Mnuchin. So this is really a driving factor that's sort of keeping the market performance afloat, and something that, we believe, will come, right? So even though there's a stalemate right now, for a lot of different reasons, there's a short legislative calendar, you have the Supreme Court confirmation, right, with Barrett, and then you have, just individual party differences. There's not a real sense of urgency to move the ball because markets are still doing relatively well. And then the other piece here is that essentially US household savings as a result of the first stimulus, right, and the CARES 1, has essentially boosted those savings numbers to levels that we haven't seen in the last decade. And those numbers have yet to be exhausted. So even though Americans are unemployed, the savings rate is rather high. So there's not necessarily the sense of urgency to get this done before November 3rd, which strategically, it could be a win for the Democrats. But that being said, it is going to come to a head. And we do expect for there to be more fiscal stimulus. And I think that's why markets, while they do get a little choppy on this news, have stayed relatively positive.
Thank you for that. Just going right on to the next topic, what are the biggest hurdles facing the current candidates? What is the likelihood of a Biden win?
Yeah, no, that's a great question. So, when we're thinking about stimulus and the economy. What's critical here, and Joe actually hit on this, the media, right, has driven a major narrative. It's a perception, some perception or fact, depending on, which side of the aisle you're on, about, the handling of the economy and COVID-19 response from Trump, right? And that's been, from a Democratic strategist perspective, the only thing that's really stuck. He's been Teflon. And that's the big thing that his polling numbers are hinging on. Now, on the other side, and I think this is really important because people don't necessarily think about this, is that the pandemic has also had a major impact for Biden. So in the Democratic primary, we saw voter turnout significantly low because they didn't have the mail-in voting process as expansive as it is today. And so it was actually down 21%. And so that's why in all these debates, you see Biden time and time again, turning directly to the camera and saying, vote, 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 right? To sort of overcome that hurdle. And I believe it's 28 million people have voted as of 9 a.m. this morning. So that is compared to 3 million people last time around. So that messaging is working for the Democrats, which is why a lot of the polling does have Biden, consistently ahead, right, at a 9-point lead, but you're looking at probabilities closer to 80% that he would win. So it is looking like, if there isn't a major, surprise, right? It's October, they call it the October surprise. I think we've had a couple already, but if there isn't anything to derail in the next 14 days, Biden is a likely winner.
And what are the policy implications? So, I definitely want to turn this back into talking about markets and economy, and I know that we're going to get there. We're going to get to the significant body of work that you've done at Morgan Stanley, but what are the likely policy implications of a Democratic or Republican win?
Yeah, so when we're thinking about, what happens if Biden wins, right? That's the next question, right? So if he's at an 80 to 85% probability based on which pollsters you're looking at, what does that mean for our wallets? And, first and foremost, it is our base case that regardless of who is president, we do not expect major tax changes for individuals in 2021, right? So the political narrative, right, is going to continue to be recovery and fiscal stimulus and more spending. At the end of the year, if Biden is president, you may see negotiations begin discussing taxes, but it would not be retroactive. So you would look for that individual tax change to occur into 2022. But what's important here, and Becky, this is actually on one of the slides I wanted to highlight, is that whenever you're thinking about the public policy debates, you need to remember that more than just the White House is at stake. So if we just want to get this next one, yeah, love that. So more than just the White House is at stake. So you can see here that we have House races up, but we also have Senate races up. And so the Democrats have 12 seats that in the Senate, and the Republicans have 23, right? So the Senate's up for grabs. But the thing that's critical here is that the vast majority of toss-up states are currently held by Republicans. So that means places like Georgia, Iowa, Maine, Montana, North Carolina, I think South Carolina is now in play. So that means that if the momentum, right, continues and the Democrats are able to flip the Senate, you're talking not about an influx of AOC far left, Democratic socialists coming in. You're talking about truly left of center Democrats. So we believe that would, help to temper, those Democratic policies. I can get into, Becky, a little bit about the corporate tax agenda and maybe, how that might impact folks. Is that?
Sure. I think that the tax implication is relevant to our religious institutions, particularly as we think about the transfer of wealth that's going to be happening over the next 20, 30 years, which they say is, could be in the next 30 years as much as $20 trillion of transfer of wealth. So, but corporate taxes also is important when you think about capital expenditures in the corporate landscape. And so if whatever you want to talk about on either side, I think is relevant.
Yeah, no, I think talking about capital gains and estate tax, to your point, is critical, right, for this audience. Now, when we are thinking about that individual tax agenda, right, most of the policies he has in play are targeted towards people making more than $400,000 a year, okay, which is the bulk of Morgan Stanley clients, arguably. That being said, when you're looking at the estate tax and the removal of the step-up basis, what that essentially does is that it exposes people to the capital gains rate, which is currently in the 20% range, right? The sort of nuance here where people, I think, really get, while that 20% tax, say on $100,000, right, is huge. What makes this even, I think, a little bit more burdensome for our high net worth clients, right, is that if you have a capital gain for a client who has $1 million or more, right, in assets, they would then be taxed at ordinary income. So 39.6%, which is the prior Obama, right, highest tax bracket. So prior to TCJA. So they want to roll that back. So it would become ordinary income. That being said, the removal of the estate tax at 100,000, right, for that step up basis, we believe that that is a very low number, right? And that the party has really focused on the middle class, right? And making sure that people making below $400,000 are protected. So if you are inheriting a home that's $100,000, right? You live in a middle class neighborhood in the Midwest, that is sort of counter, right, to their policy agenda. So I think this really hits home the fact that while this is something that we have to take seriously and is on the table, that the legislative debate is likely to change, right? The severity and the way in which these plans are levied. So to just keep that in mind, that the number would probably be much higher and not impact on the middle class, because then you're going to have Democrats fighting each other, right, to make sure that all of these interests are being protected. Now, just from the corporate side, we do believe, right, that if Biden is president, the second half of the year, so of 2021, is going to fair game for new taxes on corporates, absolutely. But when you're looking at, we did an analysis looking at all of his policies, wholesale, no debate, pretend that everything on paper is exactly went through. You would see a 9% hit to, corporate earnings. However, when you take into consider that debate piece, we're talking about something a decline closer to 5 to 6%, which when we talk to business owners, they're actually surprised, happily surprised. And it's something that we believe that they can reasonably, adjust the balance sheet and come back from. So yes, great, an interim correction in the market when that type of behavior, policy and behavior goes through, but not something that we wouldn't rebound from rather quickly.
Great, thank you for that. And then, this is now getting to the meat of our topic, and that is all this historical data that you have put through. And again, we will make this available to everyone who wants it post this presentation. But tremendous amount of research into every election from 1928 until 2016. And clearly everyone on this call and what we do at Morgan Stanley is all about the outcomes for economic outcomes and market outcomes. So what do you see there? Guide us through how you look at this and what you found from the research.
Yeah, now I don't know if you want to pull up the slides there. When we think about historical market performance, one thing that took me by surprise, as well as my colleagues, but when we dig a little bit deeper, starts to make sense, is that when you compare annual GDP growth and S&P 500 average annual returns by party, Democrats overwhelmingly win. And a big reason for this is because of their pro-growth policies. They've been very favorable of tech, right? And we expect that while there could be continued regulation and oversight under a Democratic administration, that there is still this very close link between California tech with especially the White House now with Kamala Harris, right? So we do expect that growth momentum to continue. And especially in this coming year, we expect this trend to be significant, because not only are you going to be looking at fiscal stimulus measures, right? So that money to come and support the economy, support the markets. But you're also going to be looking at spending that's focused on infrastructure, focus on renewable energy, job creation. So there's a whole new, there's essentially a new, they call it green collar jobs, right? For example, a class that isn't very big yet. They're hoping to really build that up. So while, we do believe that there are sector-specific risks, right? Absolutely, where there will be greater regulation for some business owners, that on a whole, we don't expect future performance to really deviate from what we're seeing here. And then on the next slide, I want to be more balanced. I think that it's, in the report, you'll see that we have a part 1 and a part 2, and it is sort of overwhelmingly positive for Democrats. And a lot of that has to do with the fact that the way that the Democratic elections align with the business cycle. So that was something that Joe said right at the beginning, that the business cycle ultimately is more important than the political party, right? And I can't underscore that enough, despite this very close, correlation that we've uncovered. So that being said, when we're thinking about, next year, what's great for the market, when you look at Democrats, 1 year from a Democratic win, right, from the inauguration of Democratic president, you see across, all categories of S&P 500 sectors, you have positive performance, right? Versus with Republican win, you see it across 5 sectors. And I think this really makes sense. Your traditional healthcare, so support for big pharma in the past, that's starting to change, but it has been in the past very important. Your traditional energy sectors, that also makes sense. And then with materials, so that's everything from chemical development to construction. And a lot of that has to do with the fact that they like to deregulate, right? A lot of those types of industries. So when you dig a little bit deeper, this tends to make a lot of sense. And, I hope you are able to look at the reports and get a little more insight.
I find this chart so fascinating, not only in terms of, I just briefly mentioned it on these perceived biases of how we think a win of one party versus the other is going to affect the markets. And we can see here that, between the negative, the red shaded boxes and the green shaded boxes, that really changes quite dramatically between 12 months before and 12 months after versus 24 months after. And I think it's something that we always forget. Was this another part of the data that was, kind of enlightening for you guys to find this kind of, bias going into the election versus the outcomes after? Like, how do you reconcile that? Like, I feel like more people should be talking about that part.
Yeah, I mean, I think that I think the reason why more people don't talk about it, right, is because when you are having a subject matter expert on the air, right, on Bloomberg News, on, Fox Business, they're usually talking about a specific sector. So you get that very, in the weeds, equity analyst kind of perspective, right? Looking at that specific sector and where the risk could potentially be. But it's really important for us to take a step back and view this bigger picture and think about the larger economic business cycle trends, along with the positive policies, right? That despite regulation, do tend to also support this growth factor. And that's something that, is, I think, hard to sort of, reconcile because we think fiscal conservatism, right, is always the answer. And sometimes it is, right? And when we have a big deficit like we do right now, that is going to be something that comes into play, right, further down the road. So that's not to say there isn't a role for that. But that when you're just looking at straight market performance, Democrats tend to be more constructive. Now, in the second report, the other thing that I really like with that is that we do a deeper dive based on administration. And that is, I think, can be very helpful for people that are saying, well, wait, this has to be because of one person's policy, right? And what's interesting there is that we actually found a lot of also counterintuitive data. So, for example, oil did best under Barack Obama versus the Bushes, right? And commodities did gangbusters under Nixon because he administered one of the country's largest agricultural subsidy programs. So it had nothing to do with gold or metals. And so there's a lot of interesting things that we can parse out. But the common theme, though, right, is that it doesn't change these overarching factors, right? So while you have, these major positives within each administration, it doesn't change these larger party trends. And that's just something to keep in mind.
That's great. I just want to let everyone know that we do have the Q&A function open, the chat function open, and I see that we do have a question here, Monica, if you don't mind.
Mm-hmm.
It says, wouldn't an increase in the corporate tax rate encourage reinvestment and expansion?
An increase in the corporate tax rate?
Yeah, wouldn't an increase in the corporate tax rate encourage reinvestment and expansion? And that's something that I have heard quite a bit as well.
Yeah, I mean, I think that is definitely a second derivative, impact. But when we're talking about a correction, we're talking about we're looking at concurrent periods, right? So the market is an emotional thing, right? It's you and I behind a desk, making trades, right? And making decisions. So if there is a major corporate tax or regulation to a specific area, we do expect to see a correction, right? But to your point, we do believe that reinvestment and that the ultimate ability to adjust is still there, right? That while on paper, 9%, I mean, that is a lot, that's a big hit to earnings. That's not something anybody likes to see, but say it was that 9%. We do feel confident that maybe the correction would be a little bit longer, but that companies would still come back and that they would be able to reinvest from there.
Yeah, I just brought up this slide again, because when there's change and there's uncertainty, clearly the market never really likes it. But you can see that, there can be benefits when you don't, after the change. And as you said, after the correction has taken place. Let's see. I don't have any other questions here, but I encourage everyone to. Joe, is there anything that you'd like to hop in on?
No, thank you, Monica. It's great. And we can see it's very complicated. It's not the party, it's the economy. We could paraphrase, Mr. Carville, who worked for Bill Clinton, right? When he was asked, what's it all about? He said, it's about the economy, right? So we need to really understand where we are in the economic cycle, what the future looks like, because as we know, the market is a discounting mechanism. The market's already looking into the third quarter of next year. And sometimes the participants, as Monica said, it's all of us. It's the collective opinion of all participants, and sometimes participants, being human beings, don't necessarily have the right answer. We tend to get caught up with fear and greed, and that's what creates opportunities in the markets. And that's part of our role is to help all of you make well-informed decisions based on the intellectual capital that we have, like Monica, that can help deliver information that you may not have been exposed to, but is very helpful in terms of helping us as well as our clients understand what the future may look like.
Now, one thing I would like to add and address, because this does come up a lot in one-on-one conversations with clients, are concerns around the actual election, right? So November 3rd, what happens? What does this look like if we do have a delay or a contest? And, one thing that's really important here is, we like to emphasize that, investors should really lean into, their long-term strategies, keep that in mind, And remember that, interim volatility doesn't take away from the fact that we do expect all of this fiscal stimulus and continued spending into 2021, which for us means that continuation of a V-shaped recovery, right? So we expect expansion. We expect it to actually be gangbusters for the economy next year as a result of all of the spending that's been taking place this year and what we expect to continue into next year. Now, when we looked at 2000 and studied, from the moment, election day through inauguration day of that contested period, at the low, the market lost about 10%, okay? But it quickly retraced all of those losses after the Supreme Court decision. I believe it got kicked to the Florida Supreme Court, was finalized, okay? And at that point, they actually made up and retraced all of those losses where they were up about to the 99th%, right, of what they had lost previously by inauguration day. So for us, that means that you're looking at, sharp volatility in the interim, right, where you buckle up. You might see some numbers on Yahoo Finance or wherever, Wall Street Journal, wherever you go for your data, right, to change and look a little scary. But you have to remember that resolution is really the answer and why it doesn't change our outlook, okay? And that even if you have a contest, there are that say goes past like well into January. Very, very outlier. I don't want to scare anyone. That's not something that we expect at all. But I just want to remind you about the actual constitutional process. That what happens, say you don't have a president for whatever reason. On January 20th, what's called the roll of secession takes place, and Nancy Pelosi steps in as interim president. So then she's in charge of the military, right? She's in charge of all of the government agencies, and there's a continuity of government. She's interim, right? Acting president, not president. But in that role, it allows for the Congress to actually vote on a state-by-state delegation. So not by party, so it would have to be all of Illinois, all of New York, all of California, right? Voting for the president. And then that would actually get you to a conclusion. So no matter what, you're in a place where by the first month of the year, there are constitutional protections moving this forward. So while I think that there can be a lot of fear and uncertainty, you have to remember that, our founding fathers and, government over time have really thought this through to make sure that continuity of government is there and that, we're able to, continue on and keep business, moving as usual.
That's always reassuring to hear.
Yes.
With the 14 days to go or 15 days to go. We touched on it really quickly, Monica, with the, the expectation pre-election and then kind of outcomes post-election. But I was wondering if you had any more thoughts on the best way that investors should prepare for the election, whether there's any positioning from now until the end of the year that they should be thinking about, or again, those we kind of went over them a little bit, but anything additional on the sector opportunities?
Yeah, so, while we do believe, right, that Democrats are great for growth and the growth, sector of the markets, one thing we want to just emphasize to people is that we should be thinking about next year really as that early cycle economic recovery, right? So you want to look at cyclical stocks have a tilt toward value. And that's because even though value has typically underperformed growth, which would be like your tech, et cetera, your value space tends to benefit from rising rate environments. So for example, while financials may take a little bit of additional regulation, that sector actually might do well because they're levered to perform better with a rising interest rate environment. So we do like financials right now. So, really just look at your, small cap stocks. When you're looking at tech, look at, not super expensive ones. We still think they have some room to run, but to keep that early cycle economic recovery narrative in mind as you're positioning for 2021.
Yeah, I mean, I think that, long-term investors, you always think, That doesn't always mean just hold and just wait, but finding those sections that you should go into versus for the economic reasons, maybe less than political reasons.
And if you are looking to be more tactical, right? Say if you're, you are someone that is interested in, trying to capitalize, right, on some of this volatility, you just want to stick with the cyclicals, right? And you want to stick with, looking at investments that will then benefit from the amount of stimulus, right, and future funding going into the economy. Also, if we do have a Biden win, again, you want to look at, renewable energy is a total slam dunk. There's room for healthcare companies that actually benefit from Medicaid, right? So to do a little research there, if that's something that you're interested in for different stock picking. But so keep the policy piece in mind, but also the economic cycle.
And what do you have now on your radar between, the next 15 days? Is there anything that you are particularly looking for? Are there stumbling blocks? Are there things that you think could either derail a candidate or potentially help a candidate? I mean, already so many things have happened in the past 15 days that we wouldn't have expected, but is there anything that you're looking for now?
Yeah, so now that's a great question. It's looking at the margin, right, in which Biden takes the Electoral College, right? That's the thing we just have to remember. So even though he might be 10 points up, right, like we saw with Hillary Clinton, that doesn't mean that she can take the popular vote, but not the Electoral College. And so that really is informing our view about the length of time in which there could be a delayed election scenario. And right now, we think that that's weeks, and that's because we have about, gosh, I just did the math last night. I can't remember the exact number, but it's 15 states. I can't give you the percentage, but it's I think it's like 134 electoral college votes will be able to start counting mail-in ballots starting next week. So there are states that are beginning their count already, right before Election Day, but then there's states like New York where they are starting on November 10th. So with that divide, you're looking at, so 134 is about 50% of the 270, right, that you would need to win. So yes, there will likely be a delay, right, because all those mail-in ballots, the 28 million have to be counted. That's a lot. I mean, it's exciting to me that many people are voting. I'm a total nerd, but we don't think it's going to be just months of ongoing delay. And that's because of the way that the different states are staggering their vote counts.
Terrific. Well, we want to thank you so much. Joe, is there anything else that you'd like to add on this?
Sure. Thank you, Becky. So Betsy and Joe, thank you again for having us today. If anybody out there has any questions for us, our contact information will be up on the screen shortly. If you'd like us to speak with your investment committee, whatever it might be, please feel free to reach out, email us or call us. And Joe, your choice of days continues to be ominous for Becky and me. We were here earlier this year on the day that the pandemic-induced bear market made its low, 35% off its high. And here we are today on the 33rd anniversary of Black Monday, the single largest percentage drop in the market, where the Dow was down 22.6%, or 508 points. And who would have thought 33 years later, 508 points is less than 2% on the Dow. But that being said, we look forward to coming back. Thank you, everyone. Stay safe, and always keep in mind one of Albert Einstein's most famous quotes: in the midst of every crisis lies great opportunity. The market always gives us opportunities, so please be on your front foot. Look out the windshield and look to where things are going, not backwards. So thank you, everyone.
Thank you.
Thank you all.